Every major financial collapse gets remembered as a surprise. 1929 came after the Roaring '20s when prosperity felt permanent. 2008 came after years of confidence in modern finance when risk was supposedly managed. Each time, music, people later asked the same question: how did nobody see this coming? The uncomfortable truth is that people did see it coming. They just didn't agree on when or from where or how bad it would be. And because timing was uncertain, the warnings were ignored. That's what makes late 2026 different. This isn't a prediction built on a single bubble or one fragile market. It's the convergence of pressures that have never aligned at this scale, music, before. Debt, demographics, geopolitics, monetary policy, and market structure are all pointing in the same direction. Not toward a correction, music, toward a systemic reset. Welcome to Finance Historian. Before we get started, smash the like button and subscribe if you love financial deep dives. Comment your city and the time you're watching this. I want to see how global this community is. To understand why the next crash won't resemble 1929 or 2008, you have to understand what made those crashes survivable. In 1929, the US government was small. Debt levels were low. The financial system was primitive. When the crash came, it was devastating, but the economy eventually rebuilt from a relatively clean slate. In 2008, the system was far more complex, but governments still had room to maneuver. Debt was high, but not overwhelming. Interest rates could be cut aggressively. Central bank balance sheets could expand without immediately triggering inflation. Globalization was intact. Trust, while shaken, could be restored. Those escape hatches no longer exist. Music, the defining feature of the coming crash, isn't speculation. It's saturation. Every lever that was pulled in previous crises has already been pulled hard. Rates were taken to zero and then raised at historic speed. Balance sheets were expanded to unprecedented levels. Fiscal spending, music, exploded. Liquidity was injected everywhere it could be injected. The system didn't heal. It adapted, and adaptation is not recovery. What we're living in now is a stretched equilibrium. Markets function, but only because constant intervention is assumed. Volatility is suppressed, not eliminated. Risk hasn't disappeared. It's been redistributed into places that don't show stress until they suddenly do. This is why the next crash won't look like a stock market collapse first. It won't start with a single dramatic headline. It will begin with things quietly not working the way they used to. Treasury auctions that clear, but only at higher yields. Banks that are solvent on paper, but reluctant to lend. Music, corporate earnings that look fine nominally, but collapse in real terms. Consumers who keep spending not because they're confident, but because inflation has trained them that waiting is punished. This is not optimism, it's exhaustion. By late 2026, the debt math becomes unavoidable. U.S. government interest expense alone is on track to rival or exceed defense spending. That means borrowing to fund borrowing, not investment, not growth, maintenance. And when a system starts borrowing just to sustain itself, it becomes extremely sensitive to rate changes. Even small increases begin to cascade. Higher yields pressure housing. Housing pressures banks. Banks tighten credit. Credit tightening hits employment. Employment hits consumption. Consumption hits tax revenue. Lower revenue increases deficits. Larger deficits require more borrowing. More borrowing pushes yields higher. This loop doesn't explode immediately. It grinds. Music. That grinding effect is why comparisons to 1929 and 2008 actually understate the danger. Those were shock events. This is a structural one. The other difference is coordination. In 2008, the world moved together. Central banks cut rates together. Music, governments stimulated together. China absorbed shock through massive infrastructure spending. Supply chains held. In the next crisis, coordination is fractured. Geopolitics is no longer a background variable. Trade is being repoliticized. Supply chains are being duplicated inefficiently for security reasons. Energy markets are fragmented. Capital flows are more cautious and more nationalistic. This means the system has less flexibility just as it needs more. And then there's the most dangerous factor of all, expectations. In 1929, people didn't expect government rescue. In 2008, people learned to expect it. Today, markets are built on the assumption of intervention. The belief that when stress appears, music, policy will step in. That belief creates a paradox. The more markets depend on intervention, the less effective intervention becomes. Each rescue increases moral hazard. Each backstop raises the cost of the next one. Eventually, the market stops asking whether policy will intervene and starts asking whether it can. Late 2026 is where that question becomes unavoidable because inflation hasn't truly been defeated. It's been suppressed by tighter financial conditions that the system can barely tolerate. If growth weakens further, policymakers face an impossible choice. Ease policy and risk reigniting inflation, or stay tight and risk cascading defaults. There is no painless option. This is where the comparison to 2008 breaks completely. In 2008, inflation wasn't the constraint. Deflation was. Policymakers could flood the system with liquidity without immediate consequences. Today, every intervention is filtered through inflation expectations. That makes timing lethal. Act too late, and the system cracks. Act too early, and credibility collapses. And credibility is the only real anchor left. This is also why 2026 matters specifically. Debt rollovers accelerate. Demographic drag intensifies. Corporate refinancing cliffs appear. Government deficits widen structurally, not cyclically. The lag effects of rate hikes fully materialize. And global capital becomes more selective about where it parks. None of these factors alone cause collapse. Together, they form a compression zone. Think of it like tectonic plates. Pressure builds slowly, quietly, for years. Nothing appears wrong. Then one fault slips, and everything moves at once. The mistake people make is looking for a trigger. A bank failure, a market crash, a geopolitical event. Those will come, but they won't be the cause, they'll be the release. The real cause is that the system has been running on borrowed time and borrowed money simultaneously. That works only as long as confidence is elastic. Once confidence stiffens, systems don't bend, they break. And here's why this crash will eclipse 1929 and 2008. Not in spectacle, in scope. 1929 destroyed wealth. 2008 destroyed trust in markets. The next one threatens trust in policy itself, and the idea that the system can always be stabilized with the right combination of tools. When that belief cracks, everything reprices. Not just assets, but assumptions. What is money worth? What is safety? What is guaranteed? What is solvent? Those questions don't get answered by bailouts. They get answered by reality. In reality, by late 2026 is closing in from every side. When crashes of this scale unfold, they don't announce themselves with a single moment. There's no bell that rings, no clean before and after line. Instead, the system starts misfiring in places most people don't watch. And by the time headlines catch up, the damage is already baked in. The first cracks don't appear in equities, they appear in plumbing. Short-term funding markets tighten. Repo rates spike unexpectedly. Liquidity that used to be available on demand suddenly comes with conditions. Nothing breaks outright, but everything becomes harder to do. Rolling debt takes longer. Pricing risk gets messier. Margins shrink quietly. This is how stress actually enters the system. Banks don't fail because they're reckless. They fail because confidence in their counterparty's erroneous. One institution hesitates. Another responds defensively. Credit lines shorten. Collateral requirements rise. Balance sheets that looked fine under normal conditions start showing stress under pressure. By the time depositors notice, behavior has already changed inside the system. This is why the next crash won't begin with panic. It will begin with hesitation. Corporations will delay hiring, then delay investment, then quietly start cutting costs. Earnings won't collapse overnight. They'll decay. Revenue stays nominally high, but margins erode under higher financing costs and weaker demand. Stock prices won't crash immediately. They'll stall. Volatility will rise, but direction will feel uncertain. Investors will rotate defensively, not flee. At first, housing follows next, not because people suddenly lose faith, but because affordability has been stretched past its breaking point. High rates don't just price people out, they freeze mobility. Fewer transactions mean prices stop clearing. Appraisals lag reality. Banks tighten lending standards further. Housing doesn't need to crash to cause damage. It just needs to stop working. That's enough to hit construction, local governments, and consumer psychology all at once. Meanwhile, government finances deteriorate in slow motion. Tax receipts weaken as growth slows. Social spending rises automatically. Interest expense keeps climbing regardless. Deficits widen without any new policy decisions. This is the most dangerous phase, the one where nothing looks dramatic, but everything is getting worse. Policymakers respond cautiously. They issue reassurances. They emphasize resilience. They point to strong employment data that's already lagging. They hope time buys relief. Markets test that confidence. Bond yields rise not because of growth, but because of risk. Foreign buyers become selective. Auctions still clear, but at a price. The term premium creeps back in. That hadn't mattered for years. Now it does. Every basis point increase tightens the loop. This is where the system starts to feel heavy, sluggish, resistant, like an engine running with poor lubrication. And then comes the catalyst, not the cause. The catalyst. It could be a sovereign downgrade, a major corporate default, a banking accident in a place everyone assumed was stable, a geopolitical escalation that disrupts trade or energy flows, something that in another era would have been manageable. In this environment, it isn't. Confidence snaps not because the event is unprecedented, music, but because there's no buffer left, no slack, no belief that policy can absorb another shock without consequence. That's when selling becomes indiscriminate. Not panicked at first, rational portfolio. Risk budgets tighten. Algorithms de-risk. Funds sell what they can, not what they want to. Correlations go to 1. This is where the comparison to 2008 fails completely. In 2008, the crisis was concentrated in finance. This time, finance is the transmission mechanism, not the epicenter. The weakness is everywhere at once. Governments step in, but the response feels different. Music, heavier, slower, more constrained. Rate cuts don't inspire confidence. They raise questions. Emergency programs feel less like support and more music, like confirmation that something deeper is wrong. And here's the moment that defines whether this crash eclipses the past. When people stop asking, will they intervene, and start asking what happens after. That shift is subtle, but it's everything. Once markets begin to price the limits of policy, not just music, its actions, repricing accelerates. Long-duration assets suffer. Growth assumptions reset. Safe havens behave differently than expected. Even cash feels unstable when real returns are deeply negative and currency credibility is under scrutiny. This is where behavior changes at the individual level. Consumers pull back not out of fear, but out of caution. Businesses conserve. Hiring freezes spread. Layoffs follow with a lag. Music, political pressure intensifies. Every decision becomes contested. The economy doesn't collapse in a single quarter. It contracts unevenly, unpredictably across sectors and regions. And because the system is so interconnected, recovery doesn't follow the old playbook. You can't just stimulate demand when supply chains are fragmented. You can't just cut rates when inflation expectations are fragile. You can't just borrow more when debt itself is the constraint. That's why this crash is different. Not because it's faster, because it's harder to escape. 1929 reshaped capitalism. 2008 reshaped finance. The next one reshapes governance. It forces societies to confront the limits of debt-driven stability and perpetual intervention. And that confrontation doesn't end cleanly. It drags. Music, that's what people underestimate. They imagine a crash as an event, a moment, a dramatic fall. The real damage comes after, when the old assumptions no longer work and the new ones haven't formed yet. Late 2026 isn't about the exact date. It's about the moment when the system stops pretending the trade-offs aren't real. And once that happens, everything recalibrates. When a system enters this phase, survival stops being about intelligence or preparation and starts being about positioning. Not moral positioning, structural positioning. Where you sit in the flow of money, credit, and obligation matters more than what you believe is fair or deserved. This is where the idea of safe begins to fracture. In previous crises, safety had a hierarchy. Cash was safe. Government bonds were safe. Blue chip stocks were safer than speculative ones. Real estate was solid. Gold was insurance. In the coming crash, those categories blur. Cash loses quietly, not because it disappears, but because its purchasing power erodes faster than people expect. Inflation doesn't need to spike to do damage. It just needs to stay stubborn while growth weakens. That combination turns cash into a wasting asset in real terms. Government bonds behave in ways that confuse people. Short-term bonds feel safe until rate volatility makes them unstable. Long-term bonds suffer as term premiums rise and deficits worsen. The idea that sovereign debt is risk-free starts to feel outdated. Not because governments default, but because they inflate, extend, and reprick obligations indirectly. Equities don't fall together. Companies with pricing power, low leverage, and essential products survive longer. Everything else becomes vulnerable. Valuations that were justified by low rates collapse when capital costs normalize. Growth stories turn into refinancing problems. This isn't a market that rewards optimism. It rewards durability. Real estate becomes bifurcated. Prime assets in constrained markets hold value longer. Everything else suffers from illiquidity. Prices don't clear. Sellers can't sell. Buyers can't finance. Paper values lag reality by months or years. Gold doesn't explode upward immediately. That surprises people. It moves unevenly. Music, sometimes falling during liquidity squeezes as investors sell what they can. But over time, it starts behaving like what it actually is, a hedge against trust decay. Music, not a trade. This is where narratives break down. People expect the crash to create clarity. winners and losers, good and bad assets. Instead, it creates confusion. Assets move for reasons that don't fit old frameworks. Correlations flip. Hedges fail. Strategies that worked for decades stop working all at once. That confusion is the real damage. Because when people can't interpret signals, they freeze. They delay decisions. They hoard liquidity even as liquidity loses value. Economic activity slows not because resources are gone, but because confidence in decision-making evaporates. This is why recoveries after systemic crises feel different. They're not V-shaped. They're hesitant, uneven, political. Governments respond with reforms, but reforms lag reality. By the time new rules are implemented, the system has already adapted around them. Regulation becomes reactive, not preventive. And here's the part that eclipses 1929 and 2008. Social tolerance. In earlier crises, hardship was severe, but expectations were different. People expected volatility. They expected cycles. Today, entire generations have grown up in a world where intervention, music, was constant and stability was assumed. When that assumption breaks, frustration isn't directed at markets, it's directed at institutions. Trust doesn't just decline, it fragments. Some people retreat into self-reliance. Others demand protection. Others look for someone to blame. Politics polarizes further. Consensus becomes impossible precisely when coordination is most needed. This feedback loop between music, economics, and politics accelerates the damage because markets can recover from losses faster than societies recover from mistrust. This is where the late 2026 crash truly eclipses the past, not in numbers on a screen, but in how deeply it reshapes expectations. After 1929, people learned markets could fail. After 2008, they learned banks could fail. After the next crash, people learned that systems designed to prevent failure can themselves become sources of instability. That realization changes behavior permanently. Risk tolerance, music drops. Long-term planning shrinks. People prioritize flexibility over growth, security over efficiency, redundancy over optimization. Those choices make sense individually. Collectively, they slow everything down. The global economy doesn't collapse. It decelerates into something colder, more fragmented, and less ambitious. That's the endgame people don't like to talk about because it doesn't look like a movie scene. It looks like a slow loss of momentum. Late 2026 isn't the end of the world. It's the end of a specific illusion. The illusion that complexity can always be managed without consequence. That debt can always be rolled. Music, that intervention can always outrun reality. Once that illusion fades, everything gets repriced. Not just assets, but assumptions about growth, stability, and progress. And when assumptions change, behavior follows. That's why this crash matters more than the last two combined. Not because it destroys more, because it teaches more painful lessons.